Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
Hi, and welcome to our podcast. I'm your host, Craig Evans, and joining me today is the world-famous Bruce Norris. Today's show is our bi-weekly real estate news roundup, where Bruce and I are just going to sit back and toss it back and forth a little bit on what's going out there in real estate. So, Bruce, first of all, as a semi-retired person, welcome to the show again. How were your holidays and New Year's? How's everything treating you?
Right, it was a great holiday. It really was. We sort of start Christmas probably around the end of September. we start decorating stuff, and it gains momentum. And then we go to Christmas stores and buy more stuff. So Sandy and I are really into it. So Christmas is a big deal. We probably watched, I don't know, 24 movies and, Hallmark and that other American channel and stuff. And so, no, we both love Christmas, and it's one of our favorite holidays for sure.
Good. Well, listen, let me ask you this. Before we jump into some of the stuff I want to go over with you today, I am grateful to now be the owner and CEO of the Norris Group. But you, as my friend, I'm interested to ask, how is the quote unquote semi-retired life for the first 11 days treating you?
It feels very normal because, you and I have some projects going on, and I have speaking engagements today, and I have two of them in about 4 days. So see, that seems pretty normal, it really does.
Well, listen, let's jump in, because I do know you got to speak tonight. So I want to jump in and kind of start working through some stuff. But, I was thinking through, and Joe and I were talking about some stuff the other day about how the last quarter of real estate has looked. And even what does it look like in the last 10, 11 days since, let's say, the 2nd of January. Of what the residential real estate market is looking like. And it got me to thinking about what I've heard you talk so much about in relation to in-state and out-of-state migration, that state-to-state migration, so to speak. So we looked at some data, and from obviously 23 is not out yet, but for 2022, we've got 32 out of 50 states had an inbound moving rate higher than 50% for 2022. Now in that, they were classifying that inbound moving rate defined as the number of people moving into a state compared to the state's total number of movers. So, when you got 64% of the state is seeing an inbound rate higher than 50%. I thought that was interesting. So we kept diving in. The top state in net migration of incoming net migration was Florida. Go my home state. Was Florida, with just right at a little over 249,000 as a net incoming migration. The top loser.
That's a big number.
That's a huge number, and I'm anxious to see where 23's number at, but that was for 22. But the interesting, and I know you've talked about this a lot. And I want to get this out there and pick your brain on this. So the top loser of net migration was California with 342,000. So when you got 32 out of 50, so 64% of the states having higher than 50, you got Florida's number one, California at 342,000 as your net loser. Do you see that trend changing anytime soon? And let's say if you want to call it a mid-level micro look for like the next 10 years, do you see that kind of process changing?
No, I see it progressing and gaining momentum. And one of the reasons it gains momentum is Florida is aging. And a lot of people that end up coming to Florida are connected to the medical industry, because there's kind of a formula. When you're 65, you have 2 medical people in your life. When you're 80, you have 7. So think about that. There's a lot of people that last now to 80, and they have a 350% increase in the medical people that are involved in their life. Well, that's why you have so much migration to Florida, because it's a pretty natural thing. Most of my renters in Leesburg are nurses. That's just interesting. I didn't think that was going to happen. I thought it was going to be seniors. No, it's the nurses that came into the area, didn't know for sure if they're going to buy or not, stayed as a renter for 2 years and then bought. So that's what's going on in Florida. The states that are losing the migration will continue. The Florida and the New Yorks and the Chicago, because of the things that are going on in there. But what's really interesting about California, it's so hard to get a permit that, when you used to have a boom cycle, you'd be peaking out 160,000 new homes.
Right.
This boom cycle was 60,000. So if you go backwards, say 160 is your peak, and the year before that was 145, and then 130. If you went a whole decade and never passed 60, you didn't build those homes, accumulated. Those numbers came into what, 600,000 homes you're short. Okay, but now you're losing people, but you didn't lose pricing power because of the interest rates in place. The new home selling was not a big percentage of the market. If it was only 60,000, and you did 250,000 sales, that's 25%. That's much more than normal. But anyway, they didn't take a price hit.
Well, let me ask you this, because that's interesting. We know, and it's kind of going to something I want to talk about in a little bit with you, but I want to bring this up now in the aspect of an affordability side. We know what's happened with the appreciation of homes and the valuation of homes. How do you see that the affordability issue? Again, my home state is California, or I'm sorry, is Florida, which I think you're a smart man, because now Florida is your home state. But you've been that California guru for years. How do you see the affordability issue plays into that over, and not just in the past, but even over the next decade?
Okay, so typically what happens, you go into, let's say, go back to 2021. When you had something for sale, did it last a day? No, it may not have lasted, and maybe it didn't even last an hour without 10 people.
Right.
Okay, that's how you get to a low affordability. On the other side of that, there's another formula about what percentages of your income is being taken when you buy a house. So Florida has a history, California has a history. It actually is the same direction. California just is exaggerated. So in a market like this, you're having to spend, the median is spending 70% of their income to buy a house. You need pressure on the buying side to keep that going. That's not a normal percentage. So what's interesting is that's being maintained because the few buyers that really still want to buy are a higher percentage of cash buyers. So the financing is not as big a deal, right?
Right.
And they're just not a lot for sale. What used to be, you'd expect there would be 6 months plus of inventory, and now it's 2.5, and a lot of it is new inventory. So the builders, both in Florida and California, are representing a higher percentage of sales because it's the only thing for sale.
Well, so let me ask you this then, because if I'm looking at U.S. states as a whole, because I don't want to just focus on Florida and California, but if I look at that all 50 states, typical American homeowners saw their equity, again, this is nationally, saw their equity rise by about $20,000 or 6.8% over the last year. And that was a 2023 number. Through the end of third quarter, compared to 2022. So in that, what I thought was interesting was top 3 states that gained in equity. We just talked about the net loss of migration out of California, but California was actually number 2 of the top 3 states of equity gained. You got Hawaii that gained on average $63,000 per home. California gained on average $51,000 per resident. But yet you've also got they're the highest in net migration of loss of 342,000 people exiting the state.
One of the things that's happening. So let's talk about that equity position. I'm wondering if it's connected to a median price calculation. So your median price went up X amount of dollars. Your median price can be affected by what's actually selling. So in California, you have that home that's under 400,000. Right. Once represented 45% of the market is now 25. The other, there's other inventory that is higher priced. It represents a bigger place, a bigger spot in that formula. So your prices probably haven't gone up as much as that percentage is. The inventory that's sold has changed. But to be honest with you, it's a remarkable accomplishment that prices are where they are and are firm when your interest rate goes from under 3 to 8. That's an astonishing accomplishment.
Right. Well, so there was a report put out, the Federal Reserve put out, says 66% of Americans who own their property saw their equity rise from 139,000 in 2019 to just a little over 200,000 in 2022. So in a 3-year span, they've gone almost $62,000 of equity rise. And again, that's a national number. So you got California and Hawaii picking those ratios up. But again, if I go back and take that 10-year number that we're talking about, what do you think that looks like over the next decade from an affordability, but also from the equity in their home? But also in affecting the affordability of that, where do you see that going? I mean, you're the chart guru. I don't know anybody that can rationalize data as good as you do. So if you're looking at that and I'm giving you that snippet of data, what do you make of that?
The one thing I think about is, okay, so we know we have interest rates that are going down, probably will gradually do that. So what's going to be interesting is who comes off the sideline. Is it the seller that can't wait to sell their house with a 2.5 or 3% mortgage so they can get a 5 now instead of an 8? Or is it the person that's been sitting on the sidelines didn't want to get or couldn't get an 8 that wants to finally get in at a 5 or so? So what's happening? Let's say the equity buildup. A lot of people refied, not just once, but again and again and again. Oh my gosh, I get a chance to get a 4, a 3, a 2.5. I can go from a 30 to a 15. They're going nowhere by and large. Yep. Their equity gain is actually multiplying because if you have a 15-year loan, the equity gains quicker. If you had a 30-year loan in place for now years, that gains. And I think the mentality is I'm really not going anywhere. So that's really put a freeze on a lot of inventory. It also has created a possibility of having a positive cash flow from your occupancy, where you live. If you had to move, let's say you got transferred, there hasn't been too many times in the world where you could go, you know what? Fine, we'll just rent this thing for a couple grand more than our payment and come back when we get transferred back. That just hasn't been uttered before. So I think it's just a really interesting time where typically the inventory that is sold is 85% existing inventory. And right now it's nowhere close to that. It's about 65% and the new builds are 35.
Well, so let me tie into something you said a second ago, because we're talking about what's happening from the equity position and what they're going to do, and they've refied over and over and over. So in building that,
get money out. Think about what they did with that. If they refied, maybe they said, you know what, we can refi now and actually pull an extra 100 grand and put a pool in or an office, and our payment didn't change. So some permanent decisions were made during that time frame where they just said, man, we're good.
Well, so all right, so let me I know I've known you for I think I don't know, going on 3.5, 4 years now. I know that you hate the word, I don't say hate, but strongly dislike the word predict, right? But if you had a crystal ball that you were looking into, do you see those people pulling that equity and putting that to play? Or do you think that if they haven't already, and for the new people that that have gained this equity, let's say over the last 12 to 14 months, being able to refi into a lower process was out of the picture for them, but they've still got an equity position. Do you see people over the next 5-10 years wanting to try to put that equity to play, maybe as the rates come back down? If there's not because I know you and I have talked a lot about that as the rates come down, historically, we should see the foot start to step on the gas again as far as the amount of transactions that are happening. So as long as there's not price damage, do you see that equity being able to start getting onto the street, or do you see people sitting on that equity? And again, I don't want to say asking for a prediction, but what if you?
Yeah, no, that's fine. Well, no, we wrote a report, a couple of years ago, had a 10-year projection. So that's fine. And the projection was that you're going to have a modification of the mood. So we have this chart called the moodometer, and it calculates the percentage of income you're willing to spend on a house. It's very rarely at 70%, but it's camped there now if you're in California. Okay, so normally it goes back down to 45, but it's being stubborn because there's so little for sale, and the buyers that want it are a bigger percentage cash, and they want to buy. So I think gradually what will happen is that number that will go from 70 to a less of a number, but it'll do so on the backs of two math equations. You're going to get raises, and your interest rates are going to go from 8 to 6 to 5 to 4.5. Now, at some point, those people on the sidelines with the 2.5 may say, okay, what if they want to move to Florida? See, that's what's really interesting. So you could owe $1 million on a $2 million home in California, and it's a residence, and you can sell it and live in a much nicer home in Florida free and clear. That move will constantly make sense.
Okay, well, that
let me ask you a question from the investor standpoint, Bruce. Just like, let's say I have my house that I live in, is worth $2 million and I owe $1 million on it. I sell it and I go buy a house in Florida for $1 million. Like, I'm going to have like a really nice house. But what if I'm an investor and my investment properties are doing that in California? I owe $1 million on it, but now now can I go, own 5 properties in Florida, replace $1 million of, equity, but maybe double or triple my cash flow?
There's two major things with the California investors. The laws constantly keep changing in favor of the tenant. It is now illegal for you to get a credit report on your rental. Did you know that?
I didn't. I heard that last week. I was like, you got to be kidding me.
Yeah. So, okay, well, that's exciting. So, yeah, that's why the whole boot camp idea started to make sense, because I did that with my own stuff. I said, what do I own? I own this crummy house in Moreno Valley. And I asked a property manager one time, what percentage of the world would rent in this area? And he said 20%. So 2 in 10 would actually go there and be a renter. But the price was so significant as far as the movement of it, that when I made that transition, I bought 1.5 new homes for every piece of crud I had in California. So anyway, California is a very big help to migration to wherever it's going. New York is the same for for Florida, Chicago, Canada. Those stories exist where Florida makes a lot more sense. Even though Florida has gone up, it's very different in price still. It's about half of California median price.
All right, so let me ask you a different question. We've talked about raising equity, and that we've seen homeowners rise in equity. Fannie Mae just came out and had they have a thing that they put out called their Purchase Sentiment Index, their PSI. In the month of December, it increased 2.9% up to 67.2. Now, obviously, that's primarily the jump is due to consumers expecting and looking at mortgage rates starting to go down and what they're expecting over the next 12 months. We've got Mark Palin, a longtime friend of the Norris Group, been with I Survive Real Estate several times. He's talking about that the mortgage rate optimism increased because of a survey of a high share of consumers anticipating that coming down. But interestingly, part of what Mark was talking about, he said that homeowners and higher income groups reported a greater rate of optimism than renters. In fact, for the first time in the National Housing Survey's history, on net, the homeowners believe that mortgage rates will go down versus going up. So what it was showing was you've got, let's say, I think it was the people they were surveying. You've got more people saying it's a good time to buy, and the bad time to buy has decreased. You've got people looking at, is it a good time to sell? Went from 60% down to 57%. Is it a bad time to sell? Went from 40 up to 42%. Mortgage rate expectations, they're looking at only surveys that over the next 12 months that the PSI they're saying should jump over the next 12 months, where they're looking at 22 to 31% in relation to the purchase sentiment index. So in other words, people are saying, hey, they're looking over the next 12 months that they're looking at almost another 9% increase, that people believe mortgage rates are going up, or I'm sorry, coming down, allowing for buying space. In that process, when you've got, and I just want to kind of tie this back together, when you've got homeowners that have equity, well, again, as Joey mentioned, whether it's in their ownership of their primary residence or as a renter, as an investor, what do you believe that change and that sentiment in the interest rates is going to do from a home sale perspective or a home pricing?
I think home pricing will be more affected than the volume of sales. Okay. I don't know how many people with a 2.5% mortgage, and there's a lot of people. And there's, a very big percentage that have a 3% mortgage or under. So, I mean, I guess the best thing I can do is ask myself, if I was in that position, if I owed 2.5% interest on my mortgage, what would motivate me to go get a 5? It probably wouldn't occur. In other words, I probably made that decision. And if I got to refi money out and do a dream home kind of addition, I think a lot of people they're camped out. Now, the investor world, again, if you're coming from a more expensive state, that financing probably isn't even a strong point, because you'll probably buy something free and clear with the equity you have from a more expensive state. That seems to be a bigger trend. You also can improve your location. The age of the property can go from old to new. I think that's why that transformation was enticing to me, because I went from really lousy inventory and location to brand new houses. Right. So that was not a hard decision. And I guess that's why we even started talking to other people, because people were meeting with me with their inventory. Okay, I've got 50 houses. How many of these renters would you want, or these rentals would you want forever? Like 10% of them. The rest of them are, just in rough areas and all that. That's perfect. Let's talk. Right. Yeah. Because those locations don't improve generally. They get worse.
Right. Well, Bruce, I know it's been a busy year for you already, and you've got busy stuff tonight. So I really appreciate you taking time to speak with us and to hand the mantle off to me to continue what you and Aaron have done with the Norris Group. It means the world to me to continue that mantle and carry that on. So I appreciate you taking time today with us to talk. Joey, if you don't mind, if you can jump in and tell us what we've got coming up with the Norris Group, because I know we're making a lot of good changes, a lot of things coming. Tell me what we've got.
All right. So if you're in Florida, Next week, you're in for a treat. You get Bruce at 2 different events. So first at noon in Sarasota at the Sarasota RIA, Bruce will be the keynote speaker there. So if you're in that area, you're part of the Sarasota RIA, don't miss this one. And then that evening at the Southwest Florida RIA, Bruce will be the keynote speaker there. And that's going to be at Suite 48 in Fort Myers. So he'll be in Sarasota at noon and in Fort Myers at the end of the day. The next time you'll be able to catch Bruce on Zoom doing a presentation of how to make money in a flat market. That'll kind of give you a hint of where this is going. We'll be at the Prosperity Through Real Estate meeting on February 13th. So we're going to have 2 events that we'd love to see everybody at. The first one's going to be at June 8th, and you'll probably see more details on that on a couple months. But one of the things that Craig was being peer pressured by the panel and by everybody as they left the event was I Survive Real Estate. They said, there's no way you can let this end. So by popular demand and by Doug Duncan, cornering Craig saying, you can't let this go. You're going to be the new CEO. This can't be over. So we are going to come back with I Survive Real Estate once again at the end of October. It's going to be October 25th. We already have a date. So we look forward to seeing you guys throughout the year. And that's what's going on with the Norris Group.
Perfect. Joey, the thing on that, what I'm really excited about is that I now get to ask Bruce questions on I Survive Real Estate. He gets to be on the panel and get grilled on that now and not have the list of questions in front of him.
As you know, I never want. You know where that came from? I'll just be brief, but when we started doing the radio podcast, we would occasionally have people want the questions, and we make the mistake of giving them the questions. And the problem is I don't want to ask question number 2 after their answer number 1. Maybe it was a different, I got sent in a better direction. Well, if you ask the question that comes to your mind, they're like, what the heck? What happened to question number 2? So it went from a staccato feel because the questions were pre-planned to, I listened, and then I was like, okay, well, that second question just came to mind, and it's so much better than the one I could have thought up. And so we quit giving people questions, and I never wanted them for the same reason, because Craig, when you get the questions, you think of an answer. When you give a different answer live, it messes with you.
Yeah,
it does. The next question, you're like,
Well, listen, Bruce, I really appreciate you being here today, taking the time with us. I look forward to many more of these conversations over the years to come with you, as not only the legacy that I choose and hope to strive to be, somewhat even close to, but also as my friend. I look forward to spending these times with you. So for everybody listening, thanks so much. Have a great day. Bye-bye.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.